one man decided which banks would survive and which would collapse. He made that choice inside his own house. Somewhere in Manhattan, a man who had spent his whole life building one of the city's biggest banks watched it disappear in just 11 days. In 1907, America had no central bank. When the money system started to break down, there was no one to call. No one, except one man. If the safety of every dollar you owned depended on one man's judgment tonight, would you trust him? Lower Manhattan, late October 1907. This is the night one man saved Wall Street with his own money, though nobody standing in the cold outside a locked bank door knows it yet. The air smells like coal smoke and wet stone. A line of men in dark coats stretches around the block, waiting for a bank that will not open. Some have been standing there since before sunrise. None of them know the name of the man who is right now riding a train back into the city to decide what happens to them. You have probably never thought about who really stands behind your bank account. Not the app on your phone, not the person at the counter. The real safety net, the thing that makes sure your money is actually there, waiting, the moment you hit transfer and expect it to just work. Maybe it's a quiet feeling you've never said out loud. The sense that the whole system runs on trust you can't actually check, held up by places you've never seen from the inside. That feeling isn't fear for no reason. It comes from something real, something that actually happened. Here's a fact most people don't know. The United States went without any central bank for more than 70 years, from 1836 all the way to 1913. For decades, when the banking system started to fail, there was no one whose job it was to step in. No Federal Reserve to send emergency cash. No insurance to protect your savings. Just whoever happened to have enough money and enough courage to act. So here's the real question. How does an entire economy survive a crisis with nothing and no one standing behind it? And here's the other question. What actually made the most fiercely independent country on earth, a nation built on distrust of centralized power, hand its banking system over to something like a central bank? Both answers start in the very same week, in the very same city, behind the doors of one man's private library. And that's exactly where this story begins. The story begins here. New York City, early 1907. The country is riding a wave of easy credit, and Wall Street feels to almost everyone standing on it unstoppable. Money has been pouring into the city from an unlikely place, London. A year earlier, the San Francisco earthquake had forced British insurance companies to pay out massive claims, and gold flowed west across the ocean to cover them. That gold landed in American markets and pumped even more air into an already overheated financial system. A system nobody was watching closely enough, in a time when the word regulation barely meant anything in practice. At the center of that system sat something most Americans today have never heard of: trust companies. They marketed themselves as safer, more elegant cousins of ordinary banks, serving the city's wealthiest families. But in one key way, they were the opposite of safe. Unlike national banks, trusts operated almost completely outside federal oversight, answerable to almost no one. According to records later gathered by the Federal Reserve itself, trust companies kept only about 5% of deposits in cash on hand, compared to 25% at regulated national banks. A huge gap, sitting in plain sight the whole time. They took deposits like a bank. They lent money like a bank. They even looked exactly like a bank, from the marble lobby to the brass teller windows. But when depositors all showed up asking for their cash at once, there was almost nothing left to give them. That gap, 5% standing between the promise and the reality, between what a bank says it holds and what it can actually hand you, is the mechanism this whole story runs on. Keep it in mind. You'll see it again, in a very different building, in a very different century, on a screen instead of a ledger page. Now, the moment everything changed. October 1907. Two brothers, F. Augustus Heinze and Otto Heinze try something bold, reckless, looking back, an attempt to corner the market on United Copper Company stock. The plan was simple: buy so aggressively that anyone who had bet against the stock would have nowhere left to buy shares except from the Heinze brothers themselves, at whatever price they chose to charge. It falls apart almost instantly, in a matter of days. United Copper's price crashes, and because F. Augustus Heinze had financial ties across several New York institutions, the panic doesn't stay contained to one bad stock trade. It spreads outward, first as a rumor whispered between traders, then as confirmed fact, printed in the evening papers, to every bank and trust connected, even loosely, to his name. By October 22nd, the rumor reaches the Knickerbocker Trust Company, one of the city's largest trusts, run by a well-respected banker named Charles T. Barney. In a single afternoon, depositors pull roughly $8 million out of Knickerbocker. Tellers count cash by hand until the vault runs completely dry, and the doors close before the line outside even reaches its end. The trust stops all payments that same day. Word spreads down Wall Street like fire down a fuse. If an institution as respected as Knickerbocker can fall in one afternoon, nothing in this city is actually safe. Within 72 hours, the panic reaches the Trust Company of America, the second largest trust in New York, and threatens to swallow the whole financial system, one bank at a time, like a demolition nobody was actually controlling. The New York Stock Exchange, which had been near record highs just the year before, is now in free fall. By the time the panic finally ends, it will have lost nearly half its value from that earlier peak. And here's a fact worth stopping on. There was no government agency whose job it was to stop this. No Federal Reserve. No emergency fund built for a moment exactly like this one. No hotline, no committee, no plan. According to the National Monetary Commission's own findings, published just a few years later as a direct response to this crisis, the United States in 1907 had, by many measures, the most advanced economy on Earth, and yet it ran on a money system with nothing built in to absorb a shock like this. Into that exact gap, no agency, no plan, no safety net of any kind, steps a 70-year-old man. By most accounts, he had already been quietly stepping back from the day-to-day work of banking, happy to spend his later years surrounded by rare books instead of balance sheets. John Pierpont Morgan, not a government official, not an elected leader. A private financier, one who happened to control more money and more personal relationships across rival banks than anyone else alive in America. He was in Virginia, of all places, attending a church meeting when word of the panic reached him. He didn't send instructions by telegram and stay put. He got on the next train back to New York himself. What happened over the following 2 weeks would not just decide which banks survived October 1907 and which quietly disappeared. It would decide, in ways almost no one in that room could have guessed, how America handles every major financial crisis for the next 100 years and more, including, as you're about to see, the one your own bank may have quietly lived through without you ever noticing. 100 years, starting with a single brass key. Sunday night, early November 1907, inside the Pierpont Morgan Library on Madison Avenue, a private building, not a bank, not a government office. Around 120 bank and trust company presidents sit in Morgan's personal book vault, surrounded by manuscripts and marble, called in on short notice and in no mood to work together. Morgan has the doors locked. He puts the key in his own coat pocket. Nobody leaves until there's an agreement. No eating, no sleeping, no going home to think it over in the morning. Layer 1, the object. Take away all the history, and what's left is surprisingly simple. A key, turned once, in one man's pocket. That's it. That's the whole formal mechanism behind America's 1907 rescue at its most basic level. One man's physical control over a room. Layer 2, the real mechanism. But the key was just for show. The real work happened at the desks inside that room under gaslight, deep into the night. Morgan put together a small team, including a young banker named Benjamin Strong, who would later become the first head of the Federal Reserve Bank of New York, to go through the account books of every struggling trust company one ledger at a time. Their job wasn't about feelings, it was sorting. Figure out which trusts were simply short on cash for now and which ones were truly permanently broke. The healthy ones got emergency loans, paid for by the stronger banks in the room. The broken ones did not. No matter how liked their presidents were, no matter how many years they'd sat at that same table. Here's the twist worth pausing on. Morgan did not save everyone. The Knickerbocker Trust Company, the one that started this whole chain reaction, was allowed to fail. Morgan looked at its books and decided it couldn't be saved. According to the Federal Reserve Bank of New York's own history of that night, this was Morgan's own version of a Lehman moment, decades before that word even existed. Instead, he put his effort into saving the Trust Company of America, the one his team believed could still survive with help. Layer 3, the scale. This wasn't just a symbolic move, and it wasn't cheap. Morgan personally put up his own money and pushed, successfully, other major financiers in the room to do the same, one institution at a time, one name at a time. The industrialist John D. Rockefeller, one of the richest men alive at the time, publicly promised a large part of his own fortune to keep the banking system's credit flowing. The U.S. Treasury itself, with no emergency plan of its own, put federal money into private banks at Morgan's request. The government literally rooting its emergency response through the judgment of one private citizen inside his own house. And here's the part most people miss completely. Morgan had no legal power to do any of this. None. No law forced a single banker in that room to go along with his plan. He couldn't arrest anyone, fine anyone, or force a single signature. His only real power was his reputation, decades of relationships, and one simple, almost fragile fact. If the most trusted man in the room said a bank was safe, other bankers would lend to it. And if he said it wasn't, nobody would. The 1907 rescue wasn't built on any law. It was built entirely on the weight of one man's word. That works. Right up until that one man isn't available, or isn't willing, or is simply badly wrong about which bank to save. By the time the sun came up that Sunday morning, an agreement had been made, and the tired bankers walked out into the cold. The worst of the panic started to calm down within days. But something else had happened too, quietly, almost without anyone noticing. The whole country had just found out exactly how weak its own financial system really was, and exactly how much it had depended for one long night on the goodwill and good judgment of one 70-year-old man with a key in his pocket. One institution's goodwill. Today, that job belongs to a building in Washington, D.C., not a library in Manhattan. And the panic itself doesn't even need a physical line of people standing anywhere anymore. March 2023. Silicon Valley Bank, a mid-sized bank serving thousands of tech startups, collapses in just a few days after a wave of digital withdrawal requests. People moving their money not by standing in a cold line outside a locked door, but by tapping a phone screen from their kitchen table, still in their pajamas, without ever leaving the house. According to the FDIC's own report, depositors tried to pull out tens of billions of dollars in a single day. A modern bank run happening at the speed of a phone app instead of the speed of a line on a sidewalk. The mechanism is the same. Only the speed has changed. What happened next is really the whole point of this story. There was no 70-year-old financier called in by telegram to Washington. No locked library. No key in anyone's pocket, no all-night negotiation that runs until dawn. Instead, the Federal Reserve, working with the FDIC and the Treasury, opened emergency lending programs within 48 hours, guaranteeing deposits and putting cash into the wider banking system before the fear could spread any further. The exact same job Morgan once did by hand, alone in 1907, with his own money and a borrowed key, now done automatically, through institutions, at a speed no single person locked in a library could ever match. That's how money works when the system is under pressure, whether it's 1907 or 2023. Someone or something has to be willing to put cash into a system that's temporarily lost trust in itself. Today, that job isn't personal anymore. It's a process. It runs through committees, laws, and a group called the Federal Open Market Committee, made up of career officials who come and go over time, not through one irreplaceable person's private judgment. Remember the question from earlier. How does an economy survive with no institution standing behind it? Here's the honest answer, straight from the history. It doesn't, not reliably. 1907 worked because one uniquely trusted man happened to be alive, healthy, rich, and willing, all at the same time. That's not a system. That's luck. Everything built in the years after 1907 exists for one reason: to take luck out of the equation, for good. But that change didn't happen quietly, and it didn't happen without pushback. And this is where an important piece of history comes in. When Congress first looked at replacing Morgan's private rescue with a permanent institution, many lawmakers were afraid they'd simply be making official what Morgan had done on his own, putting huge financial power into very few hands. The Pujo Committee's 1912, 13 congressional hearings into the so-called money trust looked directly into whether a small group of New York financiers, Morgan included, held dangerously concentrated control over American credit. That fear is exactly why the Federal Reserve Act of 1913 didn't create one central bank in New York. Instead, it created 12 regional Federal Reserve banks, spreading out the power Morgan once held alone across the whole country. The lesson of 1907 wasn't just, someone needs to step in. It was, no single person should ever have to, or be allowed to, do that again. Charles T. Barney spent over 2 decades building his career, and lost nearly all of it in 11 days. Barney was the respected president of the Knickerbocker Trust Company, the institution whose collapse set off the entire 1907 panic. He was known across the city as careful, sharp, and trustworthy, the kind of banker other bankers trusted with their own money. When depositors emptied Knickerbocker's vaults in a single afternoon and the trust stopped payments, Barney didn't just lose a company. He lost the reputation his whole identity had been built on, in public, in the newspapers, in a matter of days, with no process, no safety net, and no institution standing between him and the full weight of what had happened. Weeks later, according to accounts from that time, Barney did not survive the collapse of his reputation, one of the panic's quiet, mostly forgotten losses. History remembers Morgan's rescue in great detail. It rarely remembers this part. That kind of cost, sudden public ruin turning into real human suffering, didn't end in 1907. When Silicon Valley Bank collapsed in March 2023, it wasn't just a number on a screen either, not for the people actually living through it. According to the FDIC, the bank held roughly $175 billion in deposits when it failed, much of it belonging to small tech companies and startups whose entire operating cash, their whole payroll account, sat inside that one bank with nowhere else to turn. For about 72 hours before regulators said all deposits would be fully protected, thousands of small business owners across the country woke up each morning and checked the same news page, asking themselves one simple, unglamorous question. Would they be able to pay their own employees by the end of the month? That fear, quiet, private, unglamorous, is the real, ongoing cost of a financial system with no reliable safety net. Not headlines about billionaires and bailouts. A small business owner lying awake, doing payroll math on a phone calculator at 2 a.m. Barney's story, and a 2023 founder's sleepless night, happened over a century apart, in different cities, with completely different technology, but they're strikingly alike. When trust in a financial system breaks, a real person feels it first, not an institution, not a stock index, not a headline. In 1907, that person was a bank president. In 2023, it was a startup founder. Both spent the night alone doing the math. So, what finally convinced the most independent-minded country on earth to hand its banking system over to something like a central bank? It wasn't one crisis, and it wasn't one man's brave moment, however good that scene looks on camera. It was the buildup of exactly this kind of human cost, happening again and again, documented in public, through hearings like Pujo's, through news coverage, through years of ordinary public pressure, until lawmakers finally decided that personal judgment, however smart, however well-meaning, was simply not something the country should have to depend on twice. That's the empowering part of the story, the part most retellings skip entirely, too busy focusing on the drama in the library. Here's what you can actually, practically do with everything you now know. 1. Know your own coverage today for free. The FDIC protects deposits up to $250,000 per depositor, per bank, per account type. You can check your own bank's coverage and your exact limits directly on FDIC. Gov in under 5 minutes at no cost, the most direct result of the lesson 1907 taught the country, sitting one search away. 2. Spread out your risk, the same way the Fed itself was built to do. The 12-district Federal Reserve System exists specifically because putting too much financial power in one place, or one person, turned out to be dangerous in 1907. The same idea applies to your own life. No single account at a single bank should quietly sit above what's actually covered, no matter how much you trust that bank. 3. Follow the facts, not the rumors. The Federal Open Market Committee publishes its meeting notes publicly, a few weeks after each meeting, free for anyone to read. Reading them costs nothing, and it takes the mystery out of headlines about interest rates and the Fed that are often written to sound scarier than they are. 4. Learn the basic terms before the next crisis, not during it. Words like lender of last resort, liquidity, and systemic risk aren't fancy language meant to shut you out. They're simple, precise names for the exact job Morgan did by hand in 1907, now built into official policy. Knowing them turns a scary news headline into a story you can actually follow calmly, in real time. 5. Remember that today's protections were fought for, not handed out. The safeguards you have now exist because ordinary people paid attention, journalists, investigators, angry citizens in the years after 1907, and pushed a reluctant financial system to turn what one man once did as a personal favor into an official job. That same kind of attention is still something anyone can offer today. None of this asks you to predict the next crisis, or become an economist, or lose sleep over interest rates you can't control. It simply asks you to understand that the safety net you count on every day wasn't automatic, and it wasn't free. It was built, on purpose, by people who lived through 1907 and refused to let luck run the financial system a second time. Built on purpose, not on luck. Now let's go back to exactly where we started, because every line from the opening finally makes sense. One man decided which banks would survive and which would collapse. That was J.P. Morgan, inside his own library, choosing to save the Trust Company of America, and letting the Knickerbocker Trust fail because he decided it couldn't be saved. A man who ran one of the city's largest banks watched it disappear in 11 days. That was Charles T. Barney, president of Knickerbocker, a human cost that history mostly left out. America had no central bank. There was no one to call, except one man. That gap is exactly what the Federal Reserve was built 6 years later to permanently fix. Would you trust one private citizen with the safety of every dollar you own? You don't have to anymore, and now you know exactly why. Underneath every ledger, every rescue, every locked door in this story is the same simple idea. Money was never really about the coins or the paper or the numbers glowing on a screen. It's about whether people trust each other enough to keep a whole system running when nobody is forced to, and whether that trust is left up to luck. the way it was for one long night in 1907, or protected by design, the way it's supposed to be now? If tonight's story about 1907 changed even a little how you look at your own bank account the next time you open that app, stick around. There's a lot more history buried under this city than a single library on Madison Avenue. So here's a question to sit with. If the next financial crisis depended on one powerful person's goodwill instead of a public institution, would you feel safer or more afraid?